Welcome! Today, we're diving into the quantum computing pioneer IonQ. And wow, their latest earnings report presented this fascinating paradox. They had record-breaking success and record-breaking losses, all at the exact same time. It really sent the market for a loop, but when you look under the hood, it reveals this incredibly high-stakes strategy to win one of the most important tech races of our generation.
So here's the puzzle in a nutshell. On one side, you have IonQ posting fantastic Q2 revenue, almost $21 million. I mean, that shattered all expectations. Great news, right? But then on the other side, their earnings per share, or EPS, came in at a loss of 70 cents. That was way, way worse than anyone predicted. So you can see right here why the market got so confused. How on earth can a company do so well and so poorly at the same time? To figure that out, here's our game plan. First, we'll dig into that earnings paradox. Then we'll look at their strategy, this idea of investing everything to win the quantum race. After that, we'll zoom out to their huge 2030 plan, check out what Wall Street thinks of it, and then, to keep things balanced, we'll look at the very real risks and red flags.
Okay, let's jump right into that paradox. The market's gut reaction to IonQ's announcement was for the stock to drop, and it was all because of those two numbers pulling in opposite directions. Let's start with the good news first.
So, the good news. What's absolutely wild here is just how much IonQ smashed expectations. Wall Street was hoping for $17 million. The company itself guided for maybe $18 million on the high end, but they came in with $20.7 million. That's a 15% beat over their own best-case scenario and a 20% beat on what Wall Street wanted. I mean, in any other situation, this alone would have sent the stock flying.
But this was the number that threw a huge wrench in the works, a loss of 70 cents per share. Now, just for context, last year in the same quarter, the loss was only 18 cents. So this was a massive jump in losses, and it completely overshadowed that amazing revenue growth. It caused a lot of short-term traders to just run for the exits. So the big question is, why? Where did all that cash go? And that question brings us right to the heart of IonQ's strategy. See, this isn't a story about a company failing. It's a story about a very deliberate, calculated choice. It's about spending big, really big, today to completely own the market tomorrow. You can think of it as the Amazon playbook, but for the wild world of quantum computing. This chart tells the story perfectly. Just look at where the money went compared to last year. Spending on R&D tripled. General and admin costs, which covers things like big salaries for top talent from recent acquisitions, that also tripled. And sales and marketing, that jumped 150%. IonQ isn't just growing. They are pouring gasoline on the fire to move as fast as humanly possible. And this quote from IonQ's CFO on their earnings call just nails it. He basically said, look, we know the costs are high, but quantum is a massive critical race. It's way more important to win than it is to pinch pennies right now. So the whole point is, they truly believe that dominating this market in the long run is actually the cheapest way to win. You've probably seen this before, right? It's a classic tech growth model. We all saw it with Amazon and with other huge international companies like Coupang. You spend upfront to build out your infrastructure, you grab all the market share, and you become the undisputed leader. Profitability, that's not the goal right now. Winning is the goal. And for a long-term investor, that signal can be way more important than a single quarterly profit. So if the short-term picture is all about spending, what's the long-term vision look like? This is where their strategy really starts to click when we zoom out and look at their plan for the rest of the decade. Just check out this timeline. IonQ isn't playing a quarterly game. They're playing a decade-long one. They went public back in 2021. Here we are in 2025, and they're hitting record revenues while making these massive strategic investments. But look ahead. The next huge milestone is 2027. That's when they want to build a quantum computer that can break modern RSA encryption. That's a game-changing technical achievement, and it's all leading to 2030, which is the target date for hitting over $1 billion in revenue and, most importantly, finally turning a profit. The ambition here is just staggering. they're not just trying to build a good quantum computer. They're aiming to create the world's most powerful and advanced quantum roadmap. Full stop. And that's exactly why they've been buying up companies like Capella Space and LightSync and poaching top-tier talent from places like IBM and government labs. It's all about building a lead that no one can catch. Okay, so that's IonQ's plan. But what does Wall Street, the so-called smart money, think about this super high-risk, high-reward strategy? Well, while the daily stock price is all over the place, some of the biggest names in finance are placing some very, very big bets. Here's a perfect example. The investment banking titan Morgan Stanley recently revealed that it now holds a 7% stake in IonQ. That's almost 17 million shares. A huge Wall Street firm like that doesn't make a move like this lightly. It is a massive vote of confidence, not in this quarter's profits, but in that long-term 2030 vision we just talked about. And they are not alone. Amazon, which had actually sold its entire stake before, just jumped back in, buying 850,000 shares. And on top of that, you've got these respected and usually pretty conservative analysts like Keith Fitzgerald calling IonQ an uncommon opportunity that could grow 3 to 5 times bigger in the next few years. When the conservative money starts getting this excited, something big is happening.
Now, let's be super clear. This is not a sure thing, not by a long shot. A fair analysis means we have to look at the other side of this bet. There are some very real risks and red flags that are making some investors nervous, and it's really important that we understand them too.
One of the biggest concerns is something called share dilution. To pay for all this growth, IonQ has been issuing new stock, sometimes using it to buy whole companies without spending any cash. As you can see, the total number of shares out there jumped by over 20% in about a year. And for people who already own shares, that means their slice of the pie just got a little bit smaller. And it's not just dilution. There are other worries. The recent retirement of their former CEO, Peter Chapman, felt really abrupt to some people, especially after he said he was staying on as chairman, only to retire completely just a quarter later. That perceived lack of transparency is a bit of a red flag. There also haven't been many updates lately on their next big system, called Tempo. And of course, the aggressive spending itself is a giant risk. If this bet doesn't pay off, they will have burned through an enormous amount of money. So, to wrap this whole story up, step 1 is the paradox. You accept these huge short-term losses to pay for even bigger long-term growth. Step 2 is the strategy. You play that Amazon game. Invest like crazy now to win the whole quantum race and worry about profits later. And step 3 is the ultimate goal. Become a billion-dollar profitable quantum leader by the year 2030. In the end, it really all comes down to this. IonQ has laid out one of the boldest, most aggressive roadmaps in the entire tech industry. They are betting billions today because they believe it's the only way to win a market that could be worth trillions tomorrow. The smart money is starting to believe them, but the risks are absolutely undeniable. The question isn't whether the vision is compelling. It is. The real question is, can they pull it off and be the first one to cross that finish line? Thanks for joining this explainer.